All right, hey guys, so I'm here with Steven from investingwithoptions.com. We're going to have Austin from the Leadership Council on a little bit later. Uh, but we are on the eve of what I think is going to be a historic move tomorrow. We have the FOMC. They met today, and they're going to have a press conference tomorrow. And some people are suspecting that this taper is going to happen a little bit later. I think it's about probably 50-50 whether people think it's going to be in January, and there's kind of like a minority of sentiment that thinks it's possibly going to be tomorrow. And I'm one of those people, and there's 5 main reasons why I think this is going to happen tomorrow. And the first of them involves the smaller part of the LSAP program, which is the mortgage-backed security end. And what's going on right now is we're going to get the screen share up here. Basically, you have the Fed taking way too much of the inventory. And what's happened is ever since in June, they talked about tapering, they're increasingly a larger percentage of that inventory because banks have completely stopped buying MBS compared to the excess liquidity on their balance sheets, and of course with some of the regulations they're even more reluctant to step forward. So I'm going to get this chart up here in a second to show you guys. This was a piece put out by Credit Suisse in October, which I think is pretty prescient. Is it switched to the screen share yet?
I've got no screen share yet.
On your end, Steven? Okay. Screen share. You gotta hit one of these options.
About how the majority of the MBS market is now cornered by the Fed, and since the banks aren't in it, that presents a significant liquidity problem, which the Fed will try and resolve through the taper. I'm assuming that's what's the data will show.
Yeah, exactly. And I think part of it is also that what's happened is the net liquidity that's going on at the banks since he talked about it in June, he being Bernanke, has created a situation where they're in even larger percentage of the issuance because relative to what the available capital is. So it's deceiving when you look at the actual notional value of what the banks are owning relative to what they should be buying, because the Fed is static, in their dollar amount, but what the Fed wants to happen is that therefore to be a normal marketplace eventually, and the banks participate in a way that they do, similar to the way they issue, government bonds. And part of the issue is that not only are there, there's convexity issues because they have negative convexity because they don't respond as much as the government bonds. So this is getting really serious. If you look at that document, it's if they wait till April, they're gonna have liquidity problems, and in a way they already are, because the number of failures in the MBS market is just taking off. And to give you an idea of the coolest trade web product, which is like an institutional bond making firm, their coolest product right now is a round robin piece of software where there's these daisy chain failures in the MBS market where, Deutsche Bank writes a index position with Goldman, and Goldman's on the other end with Bank of America, and each of these guys are failing because they don't have enough of the cash bond to replicate these synthetic trades, because they can't find them because there's not enough paper out there because the Fed owns it all. And so the Fed actually 2 years ago, they attached a fee to that, right? A failure fee, and they thought, they'll just pay enough, and they won't be writing these index contracts anymore. But it's too profitable, for them to they'd rather just write software so that they can finish these trades off. But it's hilarious that like that's financial innovation today, is like dealing with like the illiquidity in a market that was the deepest that you could find 10 years ago. And
yeah. It seems like the Federal Reserve is coming in, and since Bernanke back in June said we're probably going to start pulling out of the MBS market, there's like a psychological reflexivity going on where if everyone knows that the largest source of liquidity is going to pull out sometime soon, they will start to sort of front run that, pull their liquidity out, and it sort of just kind of compounds on itself. And I'm assuming that's kind of the mechanism that we're dealing with, and it's probably going to increase as we head towards those deadlines back in April.
Oh, absolutely, and it's accelerating. So the longer they wait, because the Credit Suisse piece says sell MBS until they taper, right?
Yeah.
And so they all want to participate, but not until the government's out of the way. So the longer the government absorbs a larger amount of the float by extending this, and because they've attached the MBS to the the government side, some people say they missed their window when yields were much lower on the 10-year, because now they're going to have to do some asymmetrical thing where they don't cut as much of the bond purchases as they do the MBS, or they're going to have to stomach the yields ripping, which is going to create even more convexity hedging and problems for the guys that own MBS. So it's like, and time is not on their side. I mean, these guys are they're long theta right now, and they need to act. And so three of the other reasons why I think they're going to get this over with and start this is because one of the largest criticisms that you hear of Bernanke is that he put this giant prop trade on, and he's just he's going to walk away and leave it for Yellen, right? That's the super dove. That's the middle of the road conventional wisdom. But if you really look, I remember flipping paper back when she became the president of the San Francisco Fed, and it was, if you look at a chart on Fred, her term started I think in June of 2004, and we were at the Fed funds rate was at 1% back then.
Okay.
And the next month they started the stair stepper program. She has the most experience of anyone, right? Basically doing research and being involved on a voting basis when there's been rising rates, and I think it's another policy tool that they're going to use. They're going to use the back end of the taper. In other words, if they think that rates are spiking too fast, or that the liquidities there's issues there, they'll taper their taper. In other words, the rate of change will not stay 10 or 20 billion each month, right? Because they did that back in 2004. They did quarter basis point hikes, and everyone wrote it down, and everyone that was writing MBS back then, they got shocked. I remember sitting in a Starbucks in West Hollywood when they did a 50 basis point cut and raise rather. So that's how conditioned I am to downside. Raise, and it blew everyone out of the water. And that's going to be the new stimulus in the reverse. They're going to do smaller amounts or hold off for a month, and that can be another policy tool. And they just extend the duration or shorten the duration depending on the flow dynamics of the market. So, and that's more powerful on a linear basis than QE itself or forward guidance for the next 18 months. So I think they realize that they have this extra tool that no one's thinking about much anyway. So that's reason number 3. And 4 is that you've got this idea that they're going to wait a year, that there's no difference between doing it in December or January, right? Because it's Christmas holiday and it's end of year and it's a time when there's not a lot of liquidity in the market. But people are underestimating how much of the MBS side they've already prepared for this. You know, banks have stopped buying 6 months ago. They've done their hedge ratios on their whatever they think the convexity is going to be for January anyway, right? We're halfway through the cycle. There's not a whole lot more. I think there's a couple more auctions end of month, but you know, anyone that's wrote a swap or gone into this market is already prepared for January, right? And if they don't begin, they're just going to be a larger portion on the MBS side when they've already hedged. The banks have already hedged their agency risk with the treasuries because they've got that, you know, negative convex thing going on their MBS portfolio. So there is a real difference between December and January, and it's like, I think it's like $40 billion out of the 1.1 trillion of float total, right, that they've got to work through. So I don't think it's prescient to say that you know, they're gonna wait till next year to do this, and it's going to be Yellen's policy. Like if you wanted continuity at the Fed, you'd want, right, a handoff between Bernanke and Yellen to be on the same page here. And some people say that like Bernanke is going to box her in, but if you really think about it, Yellen is the perfect person to accept and validate as a voting member, and then the chairwoman, because she's regarded as you know, the dovish of the dovish, right? Even though that I don't necessarily think that's accurate information. It's like in politics almost. You almost got you know, they say that like the GOP is probably going to be the first, you know, group to get through immigration, right? They have to bless that, right? And then you had Bill Clinton was the only president in, you know, 50 years that could do anything about welfare. It's like you need you know, that symbiotic relationship, the yin yang thing going on, to get even, you know, the doves and the hawks on the same page here. And so I think it would make sense to hand off the policy rather than, and her endorse it, rather than her have to introduce it as her own. It would lend credibility to the Fed when time is not on their side, one, and it's a policy that needs to get implemented one way or the other. And so why not have that, like, this policy is a bridge and do it tomorrow and get it over with? But that's just my view.
All right. Well, we're not going to sit around and do some sort of giant echo chamber, so I'll go ahead and play devil's advocate right here.
Right.
First off, just full disclosure, you know, I'm a net option seller, so I always tend to look for non-events.
Right.
You know, I'm short SPX put spreads right now. Probably might close them out if this is such a convincing argument. You know, I might look to close those out before this voodoo happens. And I'm not even going to say that I'm fully versed in Fed policy. You know, I normally follow price action, normally focus on equities, not the MBS market. So this is pretty interesting stuff. But I'll go ahead and take the other side for a couple of these things. First off, you talk about continuity and all these other things. Well, Yellen's been involved with the Fed. You know, she's sort of been a de facto policy leader for years now. You know, she's not some sort of, you know, brand new person that's coming in to shake things up. So she, you know, with the idea that she is going to be the next Fed chairwoman, or the first Fed chairwoman, I suppose, from a gender side of things, you know, it's one of those where they've probably been talking about this handoff for a while. It's one of those where you might say, oh, it would make sense politically for Ben Bernanke to go ahead and, you know, put some taper up on the board in December just to sort of provide that continuity and to provide credibility. But, you know, I think a lot of this, you know, it's the three Ps. You've got perception, psychology, and politics. And from the political side of things, no matter what Ben does tomorrow, it's going to piss someone off. And, you know, if they do I wouldn't even say it's a surprise taper anymore. We're expecting stuff in January, so maybe people are front loading it in December. It's one of those where from a political side of things, and from a perception side of things, I don't think it's going to happen. Let me just try and go through some notes really quick because I was trying to get some counterpoints for all of this. It's in my opinion mainly politics and psychological. If Ben Bernanke comes through while a lot does the taper while a lot of liquidity just across the board during the holiday season is drying up, and we have a large sell-off in equities, people will point to that moment as sort of the watershed moment, saying, the Federal Reserve broke the market, and I don't think that's what the Federal Reserve wants to do. I don't think that's what the current administration wants right now, as well as if we have any sort of you talk about convexity risk and what I call like a cascade sort of thing, where if this taper happens, if we see instabilities in treasuries and if we see instability in equities going into the holiday season, it's going to piss off retail investors, it's going to piss off politicians, and it may make Yellen's job a little bit more difficult down the road because they did this. Just from a political side of things. If for example, let's just say Rand Paul, for instance, says, "Oh, you're playing God with the markets," and we see that kind of result in December, it's going to be a little bit more difficult for her to get things done. She was pretty much a shoo-in. There wasn't really a whole lot of pushback with her getting nominated, but if Bernanke and Yellen pull what I would consider a political stunt like this, then there might be more repercussions than they want to deal with. So, I completely understand the liquidity issue of things. I completely understand that the banks seem to be front running the lack of liquidity, and it just seems to be a good analogy is like right before a tsunami comes, you have all the water come off the beach, right? It seems like that could be what's going on right now. It's just everyone's trying to front run each other, and it just sort of builds on each other. So that's kind of what I think is going to happen. It's not necessarily a fundamental reason. It's more of a politics kind of reason that's going on right now.
Right. So the next question is when then?
This is where I get into psychological stuff. Everyone will say, January, fresh start to the new year. We can start anew. We can resolve to be more austere and get the government out, and all that political stuff that goes along with it. So January seems like sort of a psychologically comforting date to start this, rather than the end of the year. People don't want a bleak Christmas, right? So I think that's, if anything, it's more of a sentiment sort of thing right now.
Mm-hmm. So then couldn't there be a situation where they pretty much say that it's going to happen next month? Because to not do that, right, to release the stereotypical unchanged minutes and January, I don't think they have a press conference, one. Two, they've got one in December. They may have one in January. I'm not sure on that. But they've got, well, what are they going to talk about, right? They're going to have to set some expectation. And will it matter at this point on the curve anyway if they do it now or in 30 days, less than 30 days?
Well, I think it matters because I want all my short options to expire. So it matters to me. I think,
No, but I mean, does it matter to their risk-benefit analysis? Because if they set unrealistic expectations, right, and the S&P goes up to new highs, right, to close the year, right, and by January 15th, the yields are back, on the 10-year. Give it 20, 30 basis points up, right?
Yeah.
The damage that's going to happen a month later in January is going to be so much more than right now, end of year, I think.
it's one of those where, you know, that kind of thesis where why don't they hurry up and get it over with? That kind of thesis could have been said 6 months ago, or 2011 or 2010. You know, it's just one of those where um, uh,
I think they're on record. They're on record, right? They said he said in June it was going to happen this year, right? If the economy is up to their forecast, right? We've got the 7 UR rate, right? Forget the, you know,
I
the
thought it was 6. I thought they needed 6, but it's 7.
no. He said it would be around 7% when they would start the tapering, right? The 6.5 is your floor, you know, to start talking about. Then rates, it becomes a threshold. Then they start talking about the rate. But tapering,
Okay.
they said that at 7%, that would be the area that you would start to see tapering. And then they said it would be this year, right? December's the last month in the year, and in September, right? They were concerned about this shutdown, and overnight we're going to get this budget deal.
Yeah.
So,
well, okay. Here's a question then. Have they already said that they're going to taper in January? Like, did they already say we're going to start pulling the rug out, so to speak, starting in January?
They said over the summer that if the market we would be around 7% unemployment, and if our forecasts ring true and the economy continues to improve through the fourth quarter, that we will taper this year, 2013.
Hmm.
And it was delayed theoretically in September due to, you know, supposedly the shutdown, which ended up, instead of being a, you know, 20, 30 basis point hit to GDP, ended up being negligible because
Yeah.
everyone in the government got paid just in
Yeah.
arrears and with interest.
Yeah. Okay. I'll grant that right now. What I want to ask now is what kind of trades do we look at? You know, for this. You know, I normally don't trade Fed events directionally, but I do look at volatility.
Yeah.
What I'm seeing right now, you know, you said earlier the market's already pricing the MBS market, for example, and some of the hedges that they're putting on already pricing into January, so it may not matter if they do it into December. We're seeing that in equity puts right now. You know, the VIX is up relative to the time frame that we're dealing with. You know, 30 days from now includes the holidays, so Christmas and New Year's, and we're seeing the VIX up at new 2-week, maybe 3-week highs. So it seems that a lot of this, you know, we could have something, for example, you never know what the market does. We could have a taper announcement. We see a gap down, then just a big reverse higher because the market doesn't care. But, you know, it's one of those where the downside risk, it feels as though the downside risk has already started to be priced in.
Yeah.
If you look at the VIX and if you look at, I don't think the S&P skews that high right now, but it feels as though, you know, we came into just a tiny pullback in the market. Everyone started thinking taper, you know, as we're a whopping 1.5% off the highs, and everyone's now loading up on puts, and they're yet again, you know, underexposed and just don't have a ton of long deltas on right now. I wouldn't be surprised if, you know, just like we've seen for the rest of the year, whenever the VIX makes a new higher high, we just see that premium get burn off into the next expiration date. You know,
Right.
so that's kind of what my thesis is. I think a decent trade here, you know, if you want to stay a little bit bearish, I'd say sell S&P call spreads and just go use that credit to go buy some puts in the VXX. Odds are implied volatility is going to get crushed after the event, no matter if we sell off a little bit or a lot. And then the SPX call spread will kind of keep you, you know, profitable if we do see a drop. So I think that's one possibility.
Yeah, I like that. I was out of a little bit of ideas because I got so excited about this December-January VIX futures spread, and I wanted to get, you know, some of your input. I've gone back and I've done this two or three times now where the front month VIX future has been at a $1 to $2 spread to the next month. So, for instance, January and December, and it was say at negative 120 when I put this trade on, and is going to settle out. I don't know what the print's going to be tomorrow, but it closed, the futures closed at positive 60, right? And I've been in this a couple of weeks. I'm out now. I was doing the same with the new Russell RVX futures as well, but now I'm kind of out of a position. I mean, it was a good thing. It worked really nice as a hedge, this reverse calendar. But now I'm kind of wondering if we can do it in January versus March the same way, because what's happened is you don't have full backwardation. You've had December up and come up to about a 60-cent premium to January, but you've got March still hanging out there in and April and all the way through. It's still in contango, still upward sloping. So I mean, if you really get that fear, you might see January start to come in on March or Feb.
Yeah, I'm looking at the VIX prices right now, and I'm seeing January at 15.5 and February at 16 1/3, and so spot VIX is currently above January, but it's pretty much below everything else, and that's kind of odd. The way that we're seeing the VIX move, I'd expect to see a little bit more of a bid in January. So with that in mind, I think there's actually a pretty decent trade right here. You talk about time spreads or calendars or whatever in VIX futures. I think you can play that specifically, and instead of using the VIX futures, you can use S&P options, and you can sell a time spread. Not buy a time spread, sell a time spread. That gets you long gamma, and it gets you short implieds, near term and long implieds. If you want to do January, January's fine. So I'm looking at the options that expire this Friday. So December options expiration. The 1780 call is going with an implied volatility of 20. And if you look at the January, let me see if I can figure out the exact date. So Jan, I think 17. Okay, Jan 18. That's going for an implied volatility of 14. So it's one of those where, man, hold on. I might be getting this backwards. That might, because you can't do long gamma because I'm having a huge brain fart right here. I'm thinking sell Dece by Jan, but that would put you short gamma.
Right. Yeah. See, the options. Options are one thing. They're gonna build their premium into the market makers on the options, but like the straight futures curve, and see that was the thing. Like the more and more that I've looked at like the term structure of the market, and I was realizing like, okay, if I put out a little bit more margin and I cross margin this a little bit, this is not going to go $3-4 month to month in contango, right? I've got a 30-50 cent risk if the S&P just goes to the moon. We're talking 120 points up. It's not going to get more than $3. There's no way. And my upside at $1.20 was it inverting to, and it did it. It went all the way to 80 cents. Today I wasn't on for the whole ride, but it just the risk to reward on it lately. Anytime it's gotten above like $1, $1.20, 3-4 months ago, I think it got up to close to $2. Any time where people are just long in the tooth and in upside deltas, and that gets wide. It's just like it seems like the cheapest hedge out there and seems to be working. I don't know for how long, but it's been great this year at least.
Yeah, I was trying to find a cute trade, with that sort of theme with the VIX futures, but it seems like it's just a simpler trade there. One thing that I like to look at is a comparison of the VIX versus the VXV. So the VIX is 1 month out, VXV is 3 months out, so it gives you sort of a very, very quick and dirty way to figure out, whether we're in contango or backwardation, how much near-term fear we have, how much near-term complacency. And, I think there's an edge there playing that range where, whenever the VIX goes higher than the VXV, we tend to mark that tends to mark a bottom in the markets, and I think that you can start looking for the other side of that, where you're saying, okay, it's time to play the other side of this contango, because that spread's not going to widen too much out further.
Right.
So that might be a decent timing mechanism to consider, especially on top especially on top of market rallies.
Right. Well, good. I think we got a good set of trades here, and I guess we'll just have to see what shakes down tomorrow. But
let me just round that out one more thing. On the technical side of things, gold and treasuries are putting in, quote unquote bases in the context of downtrends. And I think a lot of people are looking for those to break down, and I think they will break down, but it will be a failed breakdown. So, there might be sort of a snapback kind of trade. If gold breaks underneath, you can just look at the level, whatever 3-month or 6-month lows are. If we break underneath that, and then we reverse hard, I think that'll put in a short-term bottom, and you can play it back up. So
right.
That could occur on the reaction of the news as well.
Yeah, I've stayed away from spot gold until it hits 1,000. Then I want to buy there. But what's really interesting is the getting borrow on dust, the triple levered gold miner ETF, and it's great because you've got it flops around quite a bit. But I sold that thing in the when it was hundreds, 80s. They split it. It was just crazy. It won't get any higher than 60, 70 again. But it's just that's my favorite retail crush trade.
Yeah, those leveraged funds, just a long-term short on damn near all of them is a pretty decent bet. That's kind of like why I like shorting the VXX here. When in doubt, short the VXX. Vol will probably get crushed. We'll probably head back into contango, and that will just provide a sort of a statistical headwind to that ETN. So I think there's a pretty decent trade right there too.
Yeah, you could even in a ratio combine the two, right? For this to put a hedge on and capture this taper downside, get long Jan, sell Feb, and then when you close it out, put on the other half of your VXX short.
Yeah, something like that. Cool.
Right on. All right. Well, thanks, Steven. As always, good
pleasure.
option talk, and we'll see what happens tomorrow.
Sweet. Take care.
See ya.